Before we jump in, let me set the stage for today's episode. This isn't a surface level conversation. We're getting into real world insights, what actually works, what doesn't, and how to apply what you hear today in a practical way, whether you're building a business, a brand, or your next opportunity. And I want you to stay with me until the very end, because I'm offering a free bonus specifically for listeners who finish the episode. Something that can help you skip the line and move faster if being on this show is something you've been thinking about. All right, let's get into today's conversation. Hey guys, and welcome to another episode of the Financial Freedom Podcast. I'm really happy about today's guest, Ian Noble. He's an Austinite. He is the founder of Run Steady Investments. He's got the experience of owning small businesses in Austin. He helps entrepreneurs create time freedom with passive real estate investing. I'm really happy to have him on and talk about the Austin real estate market and the market as a whole. Ian, welcome.
Thanks for having me. Appreciate it. You talk about Austin real estate market. We've been in the danger zone the last couple of years. I'm happy to share my insight on that.
Talk about your journey. You went to UT and now live there and run a successful company and what you're doing now.
Went to UT, had a family business in Austin. It was a dry cleaning company. Bought it from my dad a couple of years after I got involved with it and was running it. I'd done that for 14 years and sold that in 2023. Along the way, I got involved in real estate. I was buying single family rentals, small commercial properties. Now I'm a full-time real estate investor. I've transitioned from the active side of real estate investing, meaning that I'm doing it myself and I'm the landlord, to now the passive side, which are generally larger scale projects and different asset classes that I wasn't involved with before. Having fun with it, bringing people into these deals. We go in as a group and invest, but we're not dealing with tenants or anything like that. The fun part of real estate.
I was joking with my wife the other night. I was like, I think I'm going to exit the landlord business. It's too much of a hassle these days.
It only takes a couple bad situations to make you really gripe about it. It's funny because so much of it is good. Then you'll have a tenant or two that causes a lot of problems. Yeah. I can tell you that's one thing that I don't miss. I still have my active stuff, but I don't pursue it to the degree I do the passive side now. Pros and cons to both, but having a bad tenant leaves a bad taste in your mouth. I had one recently, so I'm right there. I'm that burnout landlord.
How do you help clients? What do people come to you for? Questions or connections or investments? How do you help clients?
This business stemmed out of a personal need. When I sold my business, I needed depreciation and I wanted to deploy some of the earnings safely back into real estate. I got bored very quickly doing it just for myself. Run Steady Investments exist to help entrepreneurs and people similar to me, high net worth individuals, get involved in real estate. They're not real estate people. They don't want to deal with the day-to-day because there's headaches that are there. We identify properties that are low risk. We're co-investing as a group. I'm the first investor in always. It's been fun bringing people that are successful in their own place of business, but aren't well-versed in real estate, bringing them in to get the exposure on that end for them.
What's your investment strategy? Is it single family, multi, apartment, mobile homes?
My business focuses in two different areas. The first one is private lending. So that's going to be acting like a bank. Essentially, we lend out to a portfolio of single family homes. So these are to flippers, but we are not the ones flipping and we're making money on set terms. The other one is going to be mobile home parks. That's the equity side where people can have longer term benefits, tax benefits of ownership. The private lending fund is open around the clock, but the mobile home park opportunities come and go. You may have a couple per year. Those get announced to the network and off to the races.
Why mobile home? A lot of listeners on this podcast, they've been conditioned to focus on multifamily and apartments. What's the advantage of mobile home parks?
The number one advantage is the supply constraint. The multifamily industry got hurt over the last few years with a lot of new properties coming into the supply, with rents going down and occupancy not being where you needed it to be, hurt the projections of those deals. With mobile home parks, they're not allowing any new ones anymore. The city doesn't like them coming into their space. If you live in a nice community and you get to vote whether or not behind your fence is a new mobile home park, the answer is no. there's a misconception there because they're great investments from a real estate standpoint. They've been that performer under the radar for many years. There's not many fluctuations in them. Houses are getting more expensive. Cost of living is becoming more expensive. They're a great opportunity for investors to figure out a way to help people with home ownership not have to deal with all of the fixes that come along with a lot of other asset classes. But you can structure it to where even though you own that mobile home park, you don't have to own the mobile home itself. The tenant can own it and you can rent the dirt to them. It creates this cycle of people staying put. The average person stays for 14 years.
Wow.
And if they own that home and, for example, sell it, they can profit from it. They're basically finding you a new tenant without you having to do any work. There's low expenses that go into that business relative to its counterparts.
Yeah.
That's why I fell in love with it.
The audience might be asking, what's the difference between owning mobile home parks and owning a lot that you rent out like a parking lot?
There are a lot of similarities with mobile home parks. The key thing is, yes, they are by definition mobile. They're not on a foundation, but they're expensive to move. It costs somebody $10,000 to move a home that might be worth $15,000. A lot of times they stay put. The commonality between the two is that you're renting the dirt, and that would be the goal. Same thing with parking lot. Also with truck parking, that's an interesting class right now. Truck parking is making its presence known. Turns out everybody knows Airbnb, so I'll use that example. There's a site for nearly every asset class that is untraditional, similar to Airbnb. Truck parking has it. It's called a Truck Parking Club. Storage facilities have it. There's lots of ways to do it. If you think about highest and best use of the land, sometimes that is a protected class. We're going off subject, but I like talking about truck parking. You'll have them next to nice neighborhoods. These truck drivers make good money and they need a place to park their rig. The neighborhoods today aren't going to let you do that again. That is another one of those protected classes that are grandfathered, but you're not getting new ones.
Quick pause here, because if this conversation is resonating with you, you'll want to stay until the very end. At the end of this episode, I'm giving listeners who finish priority access and the ability to skip the line if being a guest on this show is something you've been considering right now. No action needed. I'll share exactly how it works at the end of the episode. All right, let's get back to the conversation. There's an area in Houston where the trucks park on the street and they're protected, but a lot of the homeowners complain because there's size pollution. It's hard to see around them. The other question I have for you, in traditional asset class like single family, you deal with tenants, toilets, and trash. What's upkeep do you need for mobile home parks?
You're supplying the infrastructure, the utilities. They're paying the utilities. You'll have to run the electric pedestal there. You want a park that has sewer lines in it. There are many parks that have septics. That's a whole nother world. You're maintaining that as the property owner unless you have everything run to the city. Sometimes there's a master line that goes to the end of the property. Even if it has city sewer, you are responsible for the lines that go to the homes. There are scenarios where you're not. The city virtually has the responsibility of it all the way up into the electric pedestal, the connections and fittings. Depending on the park, those are more desirable. You're dealing with road maintenance, trees, fields, cutting the grass, things that are pretty simple. You can have the same ownership headaches that somebody else could if they are all park-owned homes. Park-owned homes bring in more revenue. It means the park owns all those homes. You are dealing with more turnover, fixing tenants, toilets. A big push in the industry is to convert those into tenant-owned homes. Wow. If you're selling that home at cost or under market, to alleviate burden of having to mess with the maintenance moving forward. Big push for that. They trade the highest in the industry when it's set up where tenants own all of the homes. It's like pressing the easy button when you go into that thing.
Yeah.
I'm oversimplifying, but it's much easier.
You're dealing with passive investing, raise capital and funds into these deals. Your portfolio has commercial properties, and people are inquiring because in this day and age where remote and companies are offloading office space, where does commercial properties sit in one's portfolio?
I'm a big fan of it. I've done it personally for years. It's not part of our options yet as a company, but on the personal side, I think that if you're looking at triple net retail property, it could be a really good investment. you put a lot of the burden and the expenses back on the tenant. And there's a longevity piece to that. If there is a work from home movement, you have to identify where your building is, if it's in a high traffic section of town, and what the tenant mix could be. For example, personally, I have nail salons, smoke shops, private offices, dry cleaners. These are things that AI is not going to take away. A restaurant. These are examples. I think it's always a good opportunity for people to get involved. You're thinking about more risk when you have one tenant, just like you would with a single family house. There's more risk that comes with buying a commercial property with one tenant. That would be for any asset class.
Is this strategy specific to Austin and the Colorado markets, or can this strategy work in other cities that may not have similar characteristics, for example?
Great question. A lot of Austin and Colorado is my personal portfolio, because I grew up in town here and Colorado as a kid. I love both. They call Colorado Texas's backyard playground. I didn't know this, but the Colorado people there, I asked them what they thought about Texans, and they don't like them. Why don't you like Texas? We're generally friendly people. I said, because you guys drive up our real estate values by buying your vacation homes here. Yes, the principle can work all over. A lot of them are going to be growth states. The Southeast is very popular right now. The Carolinas, Georgia, Tennessee, these are all markets that a lot of people are looking for that are landlord friendly and have growth in economy. I have not gotten into the Dakotas or Montana, some of these remote places. It's all over the US. It doesn't have to be centered in Texas. Austin is a tight market. Cash flow is limited. You're buying for sit, hold, and hope it appreciates. It doesn't fit our thesis, what we're looking for as a business.
A lot of the audience, they're high net worth, high income, and they've grown and sold a business. What is the safest way to put those funds for safekeeping, but also to fight against inflation and taxes?
I'm a big advocate of making sure that you spread it out. Number one, I love real estate. I'm in the market and dabble in other businesses. For business owners, the idea, I'll speak from personal experience. Day one after I sold my company was money market accounts. At the time, they were earning 5.5%. This is 2023. That's not the case anymore. But the idea was, if you can level up taking on a low amount of risk, in addition to make the best of what the opportunity is. You don't want to put your money at risk. You definitely want to focus on lower risk investments. There are other alternatives out there. It starts with, especially in the world of passive real estate investing, relationships are key. Numbers lie a lot, and you'll get investors all the time send me deals and they're like, what do you think about this pro forma? And you can tell they made that on Canva, and it's a nice marketing brochure. It's important for people to really make sure that they talk to somebody they trust and that they feel they can align with. At the end of the day, as a passive investor, it is a partnership. These deals have a longer lifespan, and your money's going to be tied up into them for a while, like it would with any property. You want to know that you communicate well, that you like the person. That's been a big thing that I've been asked a lot lately. What's your underwriting look like? A lot of it before the deal is the person, because a person can turn a good deal bad, and vice versa. An average deal can become a good deal if the right person's running it. I spent a lot of time trying to find the best partnerships and people that I feel confident going to my network, family, and my wife saying, this is what we're going to do, because I'm always the first investor in. It's a unique business model because everyone's money that's coming in is more important than mine. I'm looking at it through the lens of, is this investment good for me first with my own money? Then if it passes that criteria and the people are good, they get background checked, everything that we do checks all the boxes, it comes to the group and we can all do it as a team.
How is your investment strategy going to change or stay the same? How are you positioning with the exit of Jerome Powell in May? Trump is almost 1 year into his presidency and another 3 years. How are you positioning for your portfolio? How should people be thinking?
I think right now is a good opportunity for people that are buying on the buy side. A lot of sellers that bought in the last couple of years, there was cap rate compression and they were buying on those rates with the debt that they had structured. They are in a pinch, they're selling at a loss and cap rates rose. So better for buyers. I believe that with Powell getting out, there's a lot of hype about interest rate drops. I wouldn't bank on it. If you're someone that likes to take action, if you can underwrite a deal today, you'll be in a much better position. If it pencils today, you're in an even better spot if there's a rate drop later on. I wouldn't wait or forecast to see if the deal works. If interest rates drop, you have to look at it being cash flowing today. Long term, from whomever is in the presidency or whatever is happening, if you're following a model of sticking to low risk opportunities, in the long run, you'll be safe. The number one thing I didn't want to do after selling my company, I worked so hard to get there. You're rewarded for it at the end, is to then end up losing because you've gone into something risky, because somebody was dangling that carrot in front of you and you wanted to double your money. Stay away from that. Number one, I applaud and I'm happy for people when that works and that's their MO. But my game plan over the next several years, because that's the type of person I am, stay low risk, hit singles, don't hit home runs, and keep going, because real estate's a long game. And so is building wealth. Unless you're like a tech founder and you have a crazy exit. I'm proud of you. That's good.
That's 1 in a million. If you're in Austin, it's more likely to happen.
That's right. A lot of Austinites in the tech space. Those people are fun to help too, because a lot of people in tech don't know real estate, and it's way different. I go to these circles. I don't know what they're talking about, but we all speak the same language of trying to improve ourselves.
How can people connect with you and learn more about Run Steady Investments?
I put together a cheat sheet for your listeners of what passive investing is, if they're curious about it, and some of the questions that they should ask. It's the kind of stuff I wish I had 10 years ago. That will get them into our ecosystem. You can go to runsteadyinvestments.com. That's my website. The cheat sheet will be the most helpful if you have any curiosity behind this.
Really enjoyed this conversation. I think the listeners will really enjoy the information, and keep up the great work.
Thank you. Enjoyed having this conversation, and appreciate it.
If you stayed until the very end, congratulations. You've earned the freebie. As promised, here it is. Email chris@drchrislewmdphd.com. You'll find it in the show notes, and simply put podcast freebie. A member of our team will reach out to you about being a guest on the show. If you found value in today's conversation, please take a moment to rate the show 5 stars and follow us on Apple Podcasts and Spotify. It helps more people discover the conversations we're having here. To be a premium guest on the show, book a spot or join our podcast community. You'll find the links in the